Hey there guys, welcome back to another video. If you're new here, I'm Jake and I make these simple investing videos. So in this one, I'm going to be showing how a DIY ETF beats an S&P 500 index. So I just typed in the prompt to explain it so new people would be able to understand how they can make a DIY ETF that beats the S&P. So the S&P 500 is a list of 500 large American companies weighted by size. The biggest companies are Microsoft, Apple, Nvidia, Amazon. They take up the most space. So when you buy an S&P 500 ETF like SPY or VOO, you're buying a tiny slice of all 500 companies at once. The catch though, you also own the worst 200 companies in that list. The ones dragging returns down, you have no choice. So the DIY ETF idea, own the best, skip the rest. A DIY ETF means you handpick maybe 15 to 20 stocks that you believe will outperform the index, specifically the top quality companies without the dead weight. The logic is simple. If the top 20 to 30 companies in the S&P generate most of the index returns, why not just own those? So it shows here 35% of the S&P 500's total gains come from just 10 stocks. So how do you actually build one? You filter for companies with these traits. Consistent revenue growth, not a one-hit wonder, but a business growing year after year. High profit margins, keeps more of every dollar they earn. Competitive moat, something that makes them hard to replace. Software, brand, network effect, patents. Recurring revenue like subscriptions, enterprise contracts, not one-time sales. Dividend growth, this is one of the most important. Raises the dividend every year, signaling financial strength. You end up with names like Microsoft, Avgo, TRI, which is Thomson Reuters, and AbbVie. Companies with real durable business models. Sound familiar? So that's the essentially what my portfolio is already building toward. Why it can beat the index? 3 reasons. No dead weight. You're not dragged down by struggling companies the index is forced to hold. Concentration and quality. Your winners have more room to actually move your portfolio. You can be tactical, trim overvalued positions, add on dips, reinvest dividends into your best ideas. A passive ETF can't do any of that. It just holds everything mechanically. The honest risk, this only works if you stay disciplined. The traps are emotional selling, panic dumping. A great company on a bad week wipes out the whole advantage. Over trading, chasing every dip or headline destroys the compounding engine. Under diversification, 5 stocks is not an ETF. It's a concentrated bet. You need 15 to 25 names across multiple sectors to get the risk benefits. Survivorship bias. It's easy to look back and say just own the winners. Picking them in advance, it's the hard part. So the bottom line, a DIY ETF isn't magic. It's a commitment to owning fewer, higher quality businesses and staying patient. The S&P 500 is a great baseline, but if you're willing to do the research and stick to your thesis through volatility, there's a genuine case that a concentrated quality portfolio outperforms it over a 10-year horizon, which is exactly the game I'm already playing. So I'm just going to ask it, what are the ideal 12 to 21 stocks? So the primary goal is going to be total returns and total returns and dividend growth. That beats the S&P. So the S&P 500's current dividend yield is 1.07%. So that's my bar to clear on income. The total return bar is tougher. The index has a compounded at roughly 11 to 12% annually over the long run, and it's up 11.7% year to date in 2026 already. So beating the S&P on total return means consistently delivering above that, not just this year, but across cycles. This thing is so slow. So the good news, what's the good news? My portfolio is actually well structured to do both simultaneously, but the two goals pull in slightly different directions depending on how you weight things. Here's how each of your layers stacks up against the dual mandate. Layer 1. Oh, it's so slow, this thing. So Talis plus banks. I like Royal Bank of Canada and TD Bank. So those are my dividend engines. Now what else? So Talis is 34% of my portfolio. It's paying a fat yield well above the S&P 500 at 1.07%, but it's sitting at 1657 today, down 3% on the day and 3% this week. The total return story here is weak. Talis has been a yield trap for a while. The banks have been better, where the return has been a lot higher. Yeah, solid yield and price appreciation over time. Layer 2. Layer 2, Microsoft plus TRI. These are your total return contributors, So Microsoft at $3.99, down 6.61 this week, barely pays a dividend. It's a compounder, not an income stock. TRI at 114 is similar. Combined, these two are 47% of my book. They're where your S&P beating aspirations need to be validated. Layer 3, Avgo, Nvidia, AMD, pure total return plays. Avgo is down 22% this week alone, sitting at 373. That's painful, but also where asymmetric upside lives if the AI custom silicon thesis plays out. Zero meaningful dividend contribution at current weights. Here's the core tension to resolve. T at 34% of my portfolio is doing a lot of the dividend heavy lifting, but almost none of the total return work. So if I want 12K a year in dividends by 2027 and to beat the S&P 500, that concentration in a low growth telecom is the main structural conflict. The clear path to both goals is rotating some of that Telus weight into something like Royal Bank or Enbridge, names that pay competitive yields but also have a genuine price appreciation story behind them. That way your income base doesn't evaporate if Telus keeps drifting lower and my total return improves. Worth thinking through before my next capital deployment. So if you got any value from the video, like and comment and subscribe to the channel. I'm trying to grow my investing channel so that I can try to document my investing journey, because I have a few goals here. I want to help people learn about investing so that they can beat the S&P 500. And I also want to document my journey so that I can have like a record to go back on, and so that I can improve my own investments. So with that being said, I'm going to end the video. Like, comment, and subscribe, and I'll be back on the next one.